Hi traders, and welcome to this lesson where we're going to talk about how to manage the currency pairs. And I think this is important, and it's important for traders that have small trading accounts as well as it is important for traders that have larger trading accounts, because I'm going to show you a way to be able to manage your margins on each of these currency pairs. So let's go ahead and dive into it. So let's go take a look at the 5 currency pairs that we do focus on. We focus on the Euro US dollar, the US dollar CAD, which only has a 2% margin. And then we're also focusing in on the Aussie CAD, New Zealand CAD, that has a 3% margin requirement. And then the CAD Swiss has a 4% margin requirement. So you can see how the CAD Swiss would be twice as expensive as it would be to trade the Euro US dollar and the US dollar CAD. Now, when trading with small trading accounts, traders can have a problem with margin levels if they don't pay attention to the margin requirement for each pair. So if a trader has a small account and does not want to have margin problems, traders can start off with lower margin pairs as they build up their trading account, which means that if you have a small trading account, instead of trading 5 currency pairs, start off with the Euro US dollar and the US dollar CAD. And then eventually as your account builds up, then you can go into the Aussie CAD or the New Zealand CAD and possibly even into the CAD Swiss. But build your portfolio up. Now, if you decide that yes, you want to reduce your margins and you want to look for ways to be able to do that, then this will certainly go ahead and help you reduce that by paying attention to the lower margin pairs first before you go into the larger ones. Now, this would be equally the same, with traders that have larger trading accounts. And let me go ahead and say this. For instance, if you have a larger trading account, all right, then you could do something like this, where you go ahead and you actually reduce your lot sizes on each pair, all right, which means traders that we can take a look at this a little bit more in depth, but which means that if you've got a $5,000, or let's say a $10,000 trading account, and you want to be aggressive on your trading portfolio, and you want to trade 1 micro lot for every $1,000, then on this lower margin requirements, like the Euro US dollar and the US dollar CAD, you could trade with 0.1 lot. But then on the 3% margin, you can go ahead and trade it with 0.07. And then on the 4% margin, trade it with 0.05. And that way, traders, you're managing your margin levels by reducing your lot sizes. Now, this is for a trader that has a larger trading account, but someone that does not have a larger trading account, then you may want to opt into starting off with the lower margin requirement pairs first, and as you build up your portfolio, then go ahead and venture into the others. And that'll help you to be able to have more margin to be able to trade pairs and be consistent with those pairs without running into margin issues. So this is a great way to be able to manage that. Now, let's take a look at brokers. Brokers have different leverages, right? So all brokers in the US have a leverage of 50 to 1. Where brokers outside the US offer leverage between 1 to 1, or at least 100 to 1, or as much as 1500 to 1. So brokers have different leveraging. That means that for a trader, you would require less margin, which means less funds, to trade a pair which provides more margin for traders to manage their open positions in drawdown. All right, which means that the less money you need in order to be able to hold as margin, you can use those funds to be able to manage your drawdown. So you can probably go through deeper drawdowns and have funds available for that, compared to a person in the US that will probably have less funds for drawdown because most of his funds have been used for leverage. So the higher the leverage, the more funds you will have available to hold larger drawdowns. Okay, so just want to make sure that everyone understands that. Now, as an example, for those that, and this might be useful for those with smaller trading accounts, A US-based trading account has a 50 to 1 leverage, which needs about, let's say, $2,000 to trade the euro US dollar. A trading account outside the US with, let's say, a leverage of 1,000 to 1 leverage would only need about $20 to trade the euro US dollar. That means that the less margin to carry the open trade, the trader has those funds to manage their open positions if in drawdown, which reduces the risk of being margin called. So there is the benefit of having a higher margin. There is that benefit of having a high margin. But I'm going to go ahead and say this. The strategy is not only built for higher leveraging trading accounts. You can still manage your risk and still do well with a 50 to 1 risk, 50 to 1 leverage, or a 30 to 1 leverage, but just simply going ahead and selecting which currency pairs you go ahead and trade, filter with those first, and then build up your trading account, and then move on to some other currency pairs with a higher margin requirement. So you can certainly go ahead and do that, as well as, of course, using the option to bank your profits every single month and using that to cover your drawdown, so that if you ever get into a situation of high drawdowns, you can make a decision to close out your positions and reset and use the money, the profits that you've generated, to fund that and be able to sustain yourself into restarting your trading account again. I'll see you guys in the next video.